Hey all, welcome to ShareTrack. This is Raj here, and today I want to talk to you about the UPS earnings result and what it means for the overall market, because it's got something to do with the economy, not directly related to genomics, but it's nice to know information. And I was reading this article on CNBC, and I thought that I should bring you my interpretation of the article and my own thoughts, and that's what this video does. So if you're interested in economics and if you want to understand what UPS is giving us as hints about the future of the market, please watch this video. With that said, please do not hesitate to press the subscribe and notify button, because it will help the channel grow. With that said, let's get started. Welcome back, friends. United Parcel Service, or UPS, reported a missed earnings and revenue in the first quarter of 2023, and it's causing its shares to fall. The weak performance may be a sign of broader economic slowdown, possibly, especially given CEO Carol Tom's comments on the state of the market. Tom cited a deceleration in US retail sales and ongoing demand weakness in Asia, both of which impacted UPS's performance. She expects volume to remain under pressure given current macro conditions. Changing consumer behavior is also affecting UPS business as their customers shift their spending towards services and categories like food and dinner. And I also suspect, over and above that, that people are using the convenience of online shopping to search and identify the product that they want to buy and finding the best price for the product, and then possibly going to brick and mortar to physically check the product and then buy. That's what they were doing before COVID. I think post-lockdown, I think they're back to the same. That could also be one of the reason. And this shift may require UPS to adjust its strategy in response. In addition, contract negotiation with the unionized workforce is currently ongoing, and the strike could significantly disrupt the company's operations. These challenges may make 2023 a bumpy ride for UPS. As noted by CFO Brian Newman in the company's fourth quarter earnings call, the company's 2023 profit margin is expected to be tighter following record profit in 2022. UPS now expects its full year earnings to fall within the low end of its initial outlook, citing challenging macroeconomic conditions and changes in consumer behavior. But friends, you should remember that when we had COVID and we had the lockdown, it was like UPS business on steroids, because people are sitting at home and placing orders for stuff that they wanted, and many things were coming through UPS and other delivery services. So comparing the COVID period to post-COVID period is like, it's not like comparing apples to apples. So we have to keep that factor also into mind. The potential impact of a strike by the Teamsters Union is significant, given it represents over 340,000 UPS workers. The union is seeking higher wages, better working conditions, and improved safety measures, among other demands, which are but natural. A strike would be the first for UPS in over 25 years if it happens, and could lead to significant disruption for businesses and consumers that rely on the company's services. And friends, as you know, it's a competitive market, and there are others that could take the business and run with it. In conclusion, the economic slowdown that UPS is experiencing, along with the changing consumer shopping behavior that I mentioned before, could potentially have an impact on genomic therapy companies that do not have any monetized products but are working on getting approval for novel therapies. As the economy slows down, investors may become more risk-averse and hesitant to invest in high-risk, high-reward ventures such as genomic therapy companies. Additionally, if consumers are spending less on retail goods, they may also be less likely to invest in these companies, as they may be perceived as a luxury rather than necessity. However, it's important to note that success of genomic therapy companies ultimately depends on the strength of their clinical trial data and the regulatory approval process. If a company's therapy is effective and receives approval from regulatory agencies, investors and consumers may still be willing to invest in and use their products. Furthermore, it's worth noting that the genomic therapy industry has been largely insulated from economic downturns in the past. This is because many of the therapies being developed are for life-threatening or debilitating diseases, which may be viewed as necessity rather than a luxury. Additionally, the genomic therapy industry has been growing rapidly in recent years, and which may help to offset any negative impacts from a slowdown in the broader economy. And I also feel that when it comes to genomic companies, investing in genomic companies, if there is a recession-like environment and the economy goes bad, then I think the Feds will have to start cutting interest rates. And when they cut interest rates, genomic companies will become much more interesting as shares, and more investment can come into genomic companies and stabilize their share price. Overall, while the economic slowdown and changing consumer behavior highlighted by UPS may have some impact on genomic therapy companies, the success of these companies ultimately depends on the strength of their clinical trial data and regulatory approval process. Additionally, the growing demand for novel therapies for life-threatening or debilitating diseases may help to mitigate any negative impact from the broader economic environment. So I'm overall cautiously optimistic. And as I mentioned, if interest rates are cut, it could potentially provide some relief for genomic therapy companies that are still in the process of developing their products and may not have monetized them yet. Lower interest rates can make it easier for companies to borrow money, which could be particularly beneficial for early stage genomic therapy companies. And if the economy becomes tough, if there's a recession down the line, the Fed will have to reduce interest rates in order to stimulate the economy, and that will have this desired effect of boosting genomic companies. And because they require a lot of funding, they'll find the funding to be cheaper. They could refinance at cheaper rates, and that will be a big help. Additionally, lower interest rates may also make it easier for investors to invest in these companies, as they may be more willing to take on risk in a low interest rate environment. However, it's important to know that interest rate cuts alone may not be sufficient to offset the patent negative impacts from an economic slowdown or changes in consumer behavior. The success of genomic therapy companies will still depend on their ability to develop effective therapies and obtain regulatory approval, regardless of the interest rate regime. The only difference I would say is that if a company gets a BLA approved in the midst of a heavy recession, probably the share price may not go as high as it could have if the conditions were better, but still it will have a jump. So that's how I look at it. Furthermore, it's worth noting that interest rate cuts may not be a guaranteed outcome. Interest rate decisions are typically made by central banks, which consider a variety of factors, including inflation, employment levels, and economic growth. While interest rate cuts may be implemented in response to an economic slowdown, they are not guaranteed, and their impact may vary depending on the specific circumstances of each company and the broader economy. Overall, the interest rate cuts may provide some relief for the genomic therapy companies. Their success will ultimately depend on a variety of factors, as I mentioned earlier. So friends, what does that mean in conclusion? So I'm thinking that assuming the consumer behavior has changed to pre-COVID levels, then I think the market and economy is still strong. It's that people just are reverting back to their old habits. However, if the change in consumer behavior is because they are spending more on food and services and less on goods that are shipped through UPS, then that sends a different signal to me. It seems to me that it's a harbinger of a recession or a downturn in the economy, in which case I think interest rate will have to go down, and the Fed will have to be less hawkish. All of those are good for the stock market. So that's how I would look at it. And with this, I would like to bring the video to an end. And if you like this video, please do not hesitate to press a like out there. And please subscribe and press the notify button so that you do not miss the next video. That's all for now, my friends. I'll catch up with you again later on. Bye for now.